Hello, Dan and Eric. It's great to have you here. You're my guest from Warm Capital, and I'm very interested in getting to know your firm. How are you doing?
Good, Tillman. It's good to be with you.
Yep, doing well. Yeah, appreciate you having us.
You're working remotely. Where in the US are you located?
I'm in Portland, Oregon today.
And I'm in Boulder, Colorado.
Yeah, I'm here in Stuttgart, in Germany. Here down the street is the headquarters of Daimler, which is one of the competitors of Tesla, and we will go into Tesla a bit later during our interview. But first, I want to have a look at you had a quite interesting and impressive performance with your two funds. It was 37 and 57% since inception of the funds. Really impressive. I want to start with the question: where do you see yourself, not only in terms of performance, but also involvement of the firm? Because this is an impressive track record and it's hard to keep it up. But how do you see yourself in 5 years?
Yeah, sure. Maybe I'll take a stab at that first. It's a pretty open-ended question, and Dan can correct me where I'm wrong or have his own thoughts. But we don't try to focus too much on the year-over-year performance, or certainly not monthly or quarterly. We're just trying to get into a position for what we view as a pretty chaotic next 10 years of investing. In our particular strategies, we look for industries that are undergoing significant changes due to a new technological innovation. And so for us, this is a great time to be stock pickers. We see a lot of misinformation. We see a lot of chaos. Within that chaos, we find a lot of opportunity. So, probably won't comment too much specifically on, performance-wise. We just think that there is abundant opportunity right now. But there's also a lot of risks and challenges embedded in this market. Given sort of the velocity of change that we're seeing on the ground level of the businesses that we study, businesses that maybe were once considered safe are no longer, in our perspective, that safe of an investment if they cannot make transition to a new type of paradigm of a technology that's being adopted. So yeah, on a high level, we're just super excited about the next 10 years. We think there's a ton of opportunity. We don't do too much sort of public-facing marketing. A lot of our clients have been with us for a long time, but we're, obviously speaking with you today, we're open to, learning from and working with new investors. And so we're excited to have that opportunity as well.
Yeah, and I might just tack on, totally agree with what Eric said, is that, the foundation of the strategy, which we launched in 2012, was to capitalize on these, really dramatic Cambrian changes that we foresaw in the market. And from our perspective, we're only going to see an acceleration of these trends. So, for those that have experience, for those that are, there's a great opportunity, to continue to compound returns, but it's really just an opportunity, and it's really difficult, and you have to execute on that as well. So we're excited, and we think that the next 10 years or so, and even the next 5 years, are have a real chance to be even more chaotic than what we've seen recently. So for stock pickers, we think it's a great environment.
Tillman here. I want to give a loud shout out to Stream by Mosaic. Stream is a super helpful tool for every investor. Stream offers a great transcript library and is getting better day by day. There are 3 reasons why Stream could also be helpful for you. First, getting up to speed quickly on new investment ideas. Second, generating new investment ideas. And third is staying up to date on existing investments. If you want to try it, you can do it 21 days for free. Just go to start.mosaicrm.com to start a free trial today. With the promo code GOODINVESTING, you will also get 20% off for the first year. So please give it a try at start.mosaicrm.com. With the code GOODINVESTING, you will get 20% off for the first year. You can find the code and the link also in the show notes below. Thank you very much. I want to show you a chart and want to hear your opinion on it. And if you discuss this kind of chart in your firm, it's the comparison of growth and value. And so are you discussing this kind of chart? And also, what is your implication if you discuss it in your firm?
This is not like a specific chart that we would probably weigh too much importance on. I think, our perspective would be, while the companies that we typically are attracted to and invest in, which are typically higher growth type of models, the distinction between growth and value is somewhat semantic. Certainly, the performance attribution that you showed shows a specific diversion in the performance relative to the type of company, but that's why I think we're so focused on being concentrated in the right names, because we're going to continue to see this big dispersion of the big winners and potentially the big losers as well. So in our view, at least, this tends to be a pretty winner take most type of marketplace. There's just an acceleration effect that we see taking place as well. So I think, from our perspective, that's not something that we try to overweight in our thinking or our specific strategies. We're ultimately just trying to find the best business models in the world that have the ability to compound out, for the next 10 years or so. So it's, obviously something that comes up in discussion, and maybe Dan, if you want to touch on that, but I wouldn't give it too much importance for us right now.
Yeah, obviously interesting in the inversion that you're seeing, and then there are specific time periods where they got more dramatic. From our perspective, we're really solely focused on business level value proposition and go forward valuations. If we thought that there wasn't going to be a precipitous decline in some of the companies that we have less favorable opinions on, we would obviously, move in that direction. But everything from us starts and ends from a business perspective, and then moves on to the valuation perspective on a go-forward basis, not a backwards basis. And, when we see, obviously we've seen certain, let's call it frothiness in components of the market that we're invested in, but not specific companies that, we're particularly invested in. So, from our perspective, it's really focused on the business, and there are, several market dynamics that haven't historically been present, in terms of winner take all or winner take most dynamics and so on and so forth. So, the interesting chart, all good stuff, but, for us, it's, all of our valuations are on a forward-looking basis, and we're just really obsessed with the customer level valuation and things like that.
Some people would have expected Arne here, who's also the founder of your firm and the brain behind it. Why can't he participate in the interview?
I think I just spoke with Arne earlier today. He's focused on the portfolio. He is truly not a guy that loves publicity. I think his kind of comfort zone and happiness is really a 24/7 obsession on the book, both kind of monitoring current positions, both on the long and short side, and looking for new opportunities. But he's just not he's not out there trying to do too much marketing or publicity. So he's comfortable kind of doing what he likes doing.
Yep, and yeah, I appreciate you putting up with at least myself. I think Eric looks great, but yeah, it's from us, everything that we try to do is it's pretty difficult to get an edge in this environment, and even our competitors that we disagree with their investment positions, we still respect everyone that's doing this because it's extraordinarily difficult. So where we can pick up small edges and small advantages, and for that it's not having our CIO necessarily do a ton of publicity, and being able to because we're looking at long-term investment horizons, think relatively slowly and methodically without a wide array of distractions. For us, we think that's the best use of our investment resources for our partners.
Maybe at this point, I also want to ask you what your roles in the firm are. I already started without an introduction, but maybe that's the point that we get some background on you, both of you.
Yeah, absolutely. So my title is Director of Research. I come from kind of a unique background. perhaps, I guess. I was an investigative business journalist and business reporter. So I essentially, went to school in New York City. I wrote about technology firms for magazines like Inc. magazine, later Newsweek. I have articles published in the New Yorker. My focus was always on technology companies primarily. And in doing that, I got the chance to interview probably hundreds of CEOs, high-level executives at technology companies. But on the flip side, I also spent plenty of time working with and speaking to different venture capitalists and some public equity investors. And so, having gone to school for both business and journalism, I think my perspective was, wow, I love writing about these high-growth technology firms, and eventually wanted to be able to participate and invest in them. And so about coming up on, 5 years ago, Arne and Dan had just kind of launched Worm Capital. Arne had read some of my reporting. I think specifically he may have read a big cover story I did on Aaron Levy at Box, which is now public, but when I wrote about the company, it was still private, and was looking for some research help and looking for maybe a bit of a differentiated type of research style. So we really like to go deep fundamental research, understand sort of the components of an industry, who all the major players are, really on a deep fundamental analysis basis. And so, perhaps those skills as a reporter and someone who can get kind of obsessed with companies and industries and go deep on something, it translates kind of interestingly and I think well to the investing side. So, that's what I'm still doing today. I'm working with Arne and Dan on research primarily. I think our perspective is, having come from, the world of media, it's incredibly difficult right now, I think, for not just individuals, but investors especially, to kind of separate the noise from the signal. So we're constantly inundated with information. And one of the primary skills that I think investors need to develop and really kind of focus on is being able to separate what matters, what's the headline that actually is driven by some fundamental issue, and versus what's noise, what's clickbait, what's something that's maybe going to capture the news cycle for 24 or 48 hours, but is ultimately not relevant and not material. So a lot of my day is just spent looking for new opportunities, trying to sift through sort of the current data landscape, and ultimately focus in on the companies that we own and are looking to own over the next few years. So that's the high level of my role, but obviously we're a pretty small org. Dan does research as well. Arne obviously spends most of his time on research, but I'll kick it over to Dan to kind of give you his background.
Yeah, nothing crazy exciting. Basically, my undergraduate degree was in molecular biology, and I wasn't really cut out for lab work. It was a little boring for my liking, and really like the multi-factor element that you get in basically investing. But when I first got into it, at a relatively low level position, and I had my CFA and I got a master's in science investment management. I was pretty shocked by the kind of legacy work done by academics and things that were presented as scientific fact that just clearly were not the case. And at the same time, that a significant portion of the industry itself is more of a marketing machine than an investing machine. So I was always attracted to kind of individual investors who had done their own thing and had kind of carved out their own niche, and especially if they had gone against the grain and done it all by themselves. So I was working at a RA in San Diego where Arne was living at the time, and he had been kind of a lone operator himself, just working 24/7, and he had done a significant amount of writing, and I was just, I was like, this is the guy. I was extraordinarily impressed with his ability to go against the grain, the deep work, the frankly lack of BS that we see in certain cities in the United States, and I was immediately attracted and wanted to work together with him to build a bigger firm and allow more opportunity for outside investors, and that's just kind of what we've been doing. And I work with Eric, and it's a relatively flat org structure. I do all our trading, and from our perspective, we think that conviction is basically how you generate returns, and getting conviction is extraordinarily difficult to do. It's a lot easier to, farm out gigantic analyst teams and have investment committees, but from our perspective, that's the way how you get middling returns, because, you start moving towards the average. It's been a great kind of adventure. And, again, as we had kind of alluded to previously, we think our strategy is well set up for the next 10 years or so. And it's every day is new, and there's something to learn at all times. So it's been great.
You mentioned the filtering out of noise and signal. Is there any hack you found or any good way to do it?
No. And if you have a hack for it, please let us know. I think the best hack is, yeah, please. The only one I've come up with is time. So time and patience. And I think, the curation of people that you follow, of sources that you respect. I think that if you spend enough time looking at, anything, it's like a puzzle. You just have to sort of take your time to put the pieces together. And that's kind of what I've found across the media landscape, is that, all the articles that come out, they all come from some genesis of an idea of an editor that has there's some sort of nugget of where everything is coming from, and trying to locate the truth in all of that. What actually is the truth behind the story? I think that's a sort of almost philosophical question, but one that is immensely challenging. And I think if I had a hack for it, I would probably license that hack and focus on that. But it ultimately, I think, is just time and patience, and sort of knowing who to follow and who not to follow.
Yeah, but maybe it's also about yeah.
No, I would just tack on. It's one of our core firm principles is that we don't necessarily believe in complexity. We just try to break things down to pixel level and then build up. And I think that when we read the contra opinions of everything that we do, maybe 50-50 on things that are in agreement, or maybe more. And some of the mistakes that, at least we perceive people to be making is, they silo themselves into only reading things that are congratulatory or almost conspiratory type information. So, we read everything. We read what's, things that support our theses, things that don't support our theses, and then, try to constantly test that. But, in terms of a formula, one of the things that, because it's not easily quantifiable, it's not easy to hold, is that the relative value of qualitative work in investing, has long been denigrated as unimportant to modeling, which we view a lot of quantitative work as commodity work. So we think that that's an edge that people can pick up, and it's not something that you can necessarily break down into a, y equals mx plus b or something like that.
One thing I find helpful as a kind of hack are the mental models or the frameworks where you hanging your data up and building them. And I have a quite interesting quote by Arne, or from your letters added by Arne. It is, early last decade I developed our current strategy from scratch. I realized that the new paradigm shift in technology needed a new valuation models, a new approach. What does that mean, this new approach?
Yeah. So all value, from our perspective, is future value. I think what our sort of overall philosophy is that, especially in industries that are undergoing a rapid shift, where you're going from technology A to technology B, requires a fundamental new framework for analyzing these business models. So it's no longer relevant, from our perspective, to try to slap on, a PE ratio or look at some sort of backwards looking metric to figure out future value. And so I think in the short term, especially across the type of universe of names that we look at that are particularly in the high growth business models, where we see a lot of our competitors maybe trip up is they get stuck in this framework of analyzing businesses using these metrics that are inherently backwards looking. And just to kind of push along what Dan was getting at earlier, it requires, we think at least, sort of a more focus on qualitative analysis to understand not just what's happening today, but ultimately where the customer is most likely to go in the future. That really requires an intense understanding of the value proposition. And so when we spot something that, maybe looks from a traditional perspective overvalued, or something that's complex, we're actually drawn to those industries because, in that complexity, that's where actually we can gain an advantage. I think another sort of Arne philosophy is that, he's a big Buffett and Graham fan, and would say that he agrees 99.9% with what Buffett has said, except for the concept of circle of competence. That's one area where we think that when investors get siloed into staying within their circle of competence, that enables us to get an opportunity and an edge by drilling into it, because there ultimately, as Dan said, from our perspective, there is no such thing as complexity. That is our job, is to break down complexity into its bare essentials and understand what's actually happening and put the pieces of the puzzle together. So our valuation frameworks really are sort of industry and company specific. They tend to be more forward looking. They prioritize different elements of a company's business model. We really focus on high growth models, margin expansion, but certainly, as Arne would say, tricky valuations. We like tricky valuations. That's actually where we can get an edge.
Yeah, Arnie's background was kind of as a cigar butt style turnaround stock investor, but things aren't the same as they were 50 years ago, where some company might have an asset that was 2x their book value, and it just you could just highlight that and it would double. From our perspective, he needed and we needed an investment framework that optimize the inefficiencies of the market that we're looking at now. And as Eric alluded to, you can't just use a simple DCF in these messy environments. So the models themselves become more basic, more vanilla, more traditional as the company grows. But the greatest opportunity for asset mispricing is when things are the least clear. And from that, we focus really heavily on different metrics than you would use historically. And at the same time, if we're looking at competitors, just because something has happened in the past is not necessary to repeat in the future. Always the good financial tagline. And we think that there's a couple market dynamics that are not being priced even accurately to this day. One is that because of the proliferation of information, the relative lack of geographic boundaries that we've seen historically, that we're seeing increasingly massive concentration in select companies. So, you have to pick that company and maybe its secondary competitor. Whereas I think, as this space has become more attractive, I think, to more traditional investors, they want a broad basket of companies in a specific vertical change. And from our perspective, that's a mistake. But at the same time, you have to build conviction, and building conviction is extraordinarily difficult and time consuming, and you really have to do it over a period of years. There's clearly value in these spaces, and we have to build a unique valuation framework model so that we are comfortable holding these specific positions, where you can't rely on more convenient shorthand metrics.
Do you like to own stable companies, or what kind of companies do you like to own?
So I think maybe first distinction is businesses that we focus on and like to own tend to grow actually fairly linearly. The growth of the companies that we own, we like to target companies that are generally growing top line over 20%. I think that in terms of stability, the market will throw prices at those businesses that are not stable. I think that what we find is that the businesses that we own are actually growing pretty stable, that there's immense opportunity for expansion, specifically within maybe their core business line, but opportunities for expansion outside. But the market misprices those on a day-to-day basis. And so we have to separate as a firm, business risk versus price risk. And so, maybe that's not exactly the question that you were getting after, But the businesses ultimately that we like to own are growing extremely fast and stably. And there's not too many of those businesses, actually. And I think that's maybe the fallacy that people fall into is believing that maybe there's 50 or 60 businesses out there that are have huge prospects and are growing, stably and over 25% year over year at a significant scale. There's just frankly not that many opportunities out there, which is why our strategy really does prioritize a heavy concentration and a pretty I'd say high bar to enter into our portfolio.
Yeah, and I might just tack on, clearly, when for us to generate successful returns, we have to be able to buy an asset that's mispriced. If we look at a stable industry, as we denigrate these kind of traditional valuation frameworks, they're pretty good, and the market's relatively efficient in those spaces. So, in a vertical that has predictive cash flows, it's relatively difficult for us, and in my opinion, any money manager to get an exceptional advantage over their peers. You're just kind of really trading around the margins. Whereas when we look at the opportunities in these messy spaces, and again, you have to be right. There's the opportunity for very significant returns, and there's an opportunity to gain a pretty sizable edge, over your competitors. Again, because you can't just use simple valuation models. It all has to be forward-looking, and you have to, be able to build confidence in your own models, as opposed to just. It's easier to look at what happened the past 5 years, throw a simple run rate on it, and then discount it back.
What role does historical data play for you?
I think of course, that's a good question. So historical data is extremely important, right? So I think that it's all a question around how much we emphasize historical data into our actual valuation framework. So just because a company was able to establish itself and grow to a certain size in the past, certainly in this environment does not necessarily mean that they will be able to continue that growth into the future. I think that this is really what we're seeing from an industry perspective, which is a consolidation. Over time, the market, as Dan points out, obviously is quite efficient. In the short term, though, I think the market does have a bit of a challenge actually understanding the consolidation of effect into one or two of the select winners. And when you consider, all business and all value proposition is generated today and into the future, historical data actually doesn't really affect, sort of customer level value proposition. So on a very basic example, if you have a business that had a great product for 30 years, a competitor comes into the marketplace with a lower cost and more efficient product, the historical data around your product sales over the last 30 years can be rendered pretty meaningless overnight. And so that's the danger that we find in this marketplace. And frankly, a lot of the danger embedded within, a lot of the passive strategies that just hold, huge baskets of stocks is that because of the sort of cost curves and the accelerating impacts of these technologies, some of these business models can be rendered pretty obsolete very quickly. That's a challenge. That's a significant challenge, not, certainly for us, but for any investor today is accurately sort of sizing up how much of the emphasis of historical data and historical success will really carry over into future value. You see that playing out with certainly in the energy industry with a lot of these old oil incumbents saying we're going to transition our business models. Well, if you look at sort of the history of business, the incumbents very rarely are able to successfully transition business models. They will put up a fight and they will put out many marketing press releases, but ultimately you have to look at where their cash flows are coming from. And if they don't truly, shift capital allocation to the new paradigm, this is why companies like Blockbuster just ultimately are rendered obsolete, and it happens pretty quickly. So I think that's the danger of looking at historical analysis and prizing it too high in your framework, is you get stuck in sort of legacy thinking. And in this environment, we think that can be pretty dangerous.
Yeah, I might just tack on. I obviously agree with what Erik said. In stable industries, it can be incredibly useful and prescriptive of the future. But in what we do, and we really only focus in these messy areas of the market, it could have zero value. I mean, I guess the only value I would say is that even if there is a superior economic model, people's consumer, either people or business consumer patterns are still relatively slow to change. So, for us, that's great because, you can compound growth over an extended period of years, and it's relatively more, it's still lumpy, but it's over, an extended investment horizon. And, that's one of the interesting things that, from our perspective, the pandemic has changed is we've seen a pull forward of probably a couple of years of rapid consumer behavioral change, if not more. So yeah, it depends on whether it's in a disrupted vertical or in a stable industry. And maybe the only value that you can get out of it is the pace of change, and even if things are moving at relatively fast rates, it still takes a while for a complete changeover to the new business model.
With your investments, you're focusing on, I think, 5 sectors. It's energy, transportation, retail, cloud computing, and digital entertainment. What sectors, or what 2 sectors out of this 5 are your top sectors?
I would say, energy and transportation would be our top sectors right now that we're focused on.
And why these?
Simply as a function of the enormous change that we forecast happening over the next 10 years. So, specifically within energy, what we're seeing is a total disruption across the energy landscape, moving from a system that has historically relied on extraction of fossil fuels to a system that is primarily based on the collection of wind and solar through storage and then distribution over a decentralized grid. And so, there's a lot to unpack within that framework. But ultimately, we're so focused on it right now because we just think everything is moving towards a renewable paradigm. It has, from our perspective, very little to do. Certainly, we follow all the political developments, but from a value proposition perspective, the costs are lower, it's more efficient, and it's only a matter of time, from our perspective at least, when we make a full transition to this new paradigm. And so, within that category, that's obviously solar and wind, but it's also battery storage, it's energy software and virtual power plants, and then of course on the transportation side, that's an enormous sort of force function for us and focus area. The disruption from internal combustion engines to electric vehicles, autonomous transportation, pretty much any modality of transportation we think is going to move towards renewables and autonomous. And so for us, this is the area to be focused on for the next 10 years if you're looking for opportunity. It's attracted a lot of attention. I think it's attracted some frothiness in the market. But ultimately, we're so focused on those 2 areas as a function of how much opportunity there is to be disrupted.
What gives you the confidence that this new paradigm will come true?
It's, from our perspective, just a function of cost and efficiency of the technologies. So it's, to talk about electric cars, it's a cheaper, more efficient mode of transportation. For many years, cost was the limiting factor. Battery production was the limiting factor. And battery energy, the density of the batteries was limiting factors. We're still not there yet. We haven't, as Arne would say, totally crossed the Rubicon. But that's what makes it, frankly, kind of exciting and challenging. But if you look really kind of on a deep historical and sort of fundamental basis, the technologies have improved rapidly over the last 10 years. That gives us a great deal of confidence that ultimately we are transitioning to this new energy paradigm.
Yeah, and just to tack on Eric's earlier first point, I mean, if these economics are more compelling and we do move in that direction, if you start to think of the secondary and tertiary effects of all that, it's almost mind-blowing how much opportunity that is and how much upheaval, primarily in a good way, that will be. And we could even it's not really investing based. But if you look at geopolitics and all around the world and where countries are deriving their revenues, I mean, it's and on and on and on. It's the one of the, it could be the greatest transformation and also transfer of market cap that we might see in our lifetimes. And just to tack on to what Eric said, in terms of technology improving, the cost compression and of what we've seen over the past 10 years, generally speaking, when you look at the forecasts that all these big agencies put out, at least historically, they've been linear, right? Whereas nothing really happens linearly. So when we focus on the nonlinear compression of cost and the nonlinear rate of adoption, that's where we start to really get excited about these opportunities, and that's where technology has been being adopted for a relatively long period of time now. And there's incentive. I mean, it's just, we can go on and on. There's a lot to unpack, and we're talking trillions of dollars, that will either be made and simultaneously lost.
You're also shorting. Yeah.
Sorry, no, go ahead.
You're also shorting and trying to stay away from certain business models. Are you shorting then in the energy sector? And maybe you can also add some light why you are shorting, besides just going long.
Yeah, I mean, maybe Dan can talk a little more about like the specifics of just portfolio construction as it relates to the shorts, but I can talk a little bit more of the philosophy behind it. I think ultimately any business model that relies on some legacy fossil fuel asset as its main source of cash flows, we think will ultimately be disrupted. So this ranges from companies that are focused on combustion engines to trucking companies, even down the value chain towards auto dealerships, auto parts retailers. So we're looking for companies that ultimately, will be rendered or could be rendered obsolete in the next 5 to 10 years. So that's the framework of how we think about, how do we find an attractive short opportunity? Obviously, and maybe Dan can talk a little bit more about this. Equity markets, it's very difficult to actively short right now, and I think it requires an immense focus on risk management, position sizing, and so on. And so, but frankly, from an industry perspective, yeah, I'd say we're looking for coal companies, oil companies, any company across the energy landscape that ultimately just can't transition its business model.
Yeah, it's been an interesting year for the short book. One thing I'll say is, if we look at our strategy, it's a natural pair trade where we look at basically the dominant winners, and then there's let's call it a handful or a basket of losers that we see the market cap being swallowed up into this new player in the field. So theoretically that produces a bit of a melting ice cube, and when these precipitous drops in quote price do happen in the market prices in the forward-looking valuation, frequently it happens very quickly. So you have to be in position, and that's what we want to do. So that's kind of the high-level strategy. When we talk about more of the past year or so and what we've experienced, last March, we took off a decent amount of risk in our book, and simultaneously increased our short exposure. As we followed the pandemic, from Asia to Europe, and it's ultimately this global destination. And for us, it allowed us to have a successful March. We ended up paying for that hedge in April and May, but we were comfortable because to some degree, and I think anyone would be lying if they knew perfectly well what was going to happen. So, if you're driving a car and you can only see X feet in front of you, you have to act accordingly. So when we basically saw the base, really high level of support that the Fed was going to get, and the fact that there was pretty tremendous single name risk in individual short positions, we spread out our names, far more than we typically have. And we typically have small short positions anyways, just due to the nature of the trade. So The other thing too is that there is no way to get familiarity in those names overnight. You know, you have to study them for years and years, know their respective weaknesses. And, you know, we had an article on American Airlines in 2016 or 17 or something like that, you know, buying back their shares fresh out of bankruptcy and, you know, putting themselves in a vulnerable position in any sort of adverse economic effect. So for us, it's, we see it as two sides of a trade, and that, you know, we'd like to profit on both. But I'd be lying if I'd say that the past year hasn't been hard to generate, you know, really significant profits on that.
But if help me to understand, if you have identified the winners and these winners could go tenfold, why the effort of shorting? Because the short is, the return you can get is limited, and you always have to find new shorts.
Yep. Obviously, the return profile is asymmetric, right? So you can lose unlimited, and you can only make 100%, which you'll never make anyways. Again, for us, it's nice to have that hedge in times of chaos. It's a comfort to, you know, our partners and us that, you know, we can limit the damage, or at least attempt to limit the damage. And again, you know, with all the work we do and everything we put in, you know, we're trying to generate the best absolute return that we can get. And if we think that we can pick up, you know, some more returns from that portion of the book, while at the same time maintaining, you know, some sort of a basic hedge, you know, we think it's an attractive proposition.
Maybe let's take a look at your portfolio. Here we go. This is the part that is publicly disclosed, and just like from the upper level, looking on the portfolio, when I try to reverse engineer this, what are the principles beside what we already have discussed, the flow and the thinking of your portfolio, the position sizing? What are these principles?
Yeah. So, I mean, generally speaking, on the long side, you know, we'll own anywhere between 5 and 15 names. You know, we're historically, you know, pretty comfortable, as long as the opportunity merits it, to be pretty heavily concentrated in a single name or two. You know, potentially up to, you know, 25 to 40%. You know, that's a pretty rare occasion, and I think we'll only have a few of those over the lifetime of our strategies. On the short side, you know, as Dan pointed out, we're certainly going to be more heavily diversified. I don't think those public disclosures really do our portfolio justice, because I think there's just some inaccuracies embedded within the 13F filings. And so, but across the short book, you know, we'll have anywhere from 50 to 85 names, roughly speaking. And we like to be concentrated in what we believe to be the most disruptive business models in the world. You know, over a longer time horizon, we believe that this is the best way to compound wealth on an absolute basis for our partners. You know, certainly, you know, I think the more traditional academic view is, you know, this will increase the volatility of your strategies and therefore increase risk. Our perspective is that headline risk and price risk are just fundamentally not the same as business risk. And so what we want to do is just truly own these companies for the long term. It requires immense amount of conviction. You know, it definitely requires patience, perhaps, you know, a bit of a contrarian mindset, and a focus on valuation. But ultimately, we believe that, you know, sort of especially in this sort of environment in which there's a lot of change happening quickly, that is the best risk-adjusted way to deliver returns for our partners, is to be pretty select in what we own, and we're able to withstand the sort of, you know, monthly, quarterly, even yearly volatility in pursuit of these, you know, truly absolute long-term gains for our partners. You know, it'd be lying if I'd say it's not a challenge. Obviously, this is the hardest game in the world. It certainly is, and certainly to kind of, when you see, you know, a deviation in the price on a on a big position, a drawdown, which are bound to happen, it forces you to really stay really focused on what the competition is saying, what the sort of contrarian thesis is, what's driving the price action, And then obviously, we're always looking for and spending years developing conviction on the next disruptive opportunity. So we don't get to, a 40 or 25% position overnight. It takes years of research and understanding of these business models to really build up to that position size.
Yeah, and I totally agree. And just to kind of like go back to what we've been talking about previously in valuation and how these things change over the life cycle of the specific investments that we look into. We have respect for our competitors in the space, and we have respect for people on the contra side of the trade. Ultimately, as these businesses mature, they become relatively easier to value. So that is, in many ways, that closes the delta between, what we believe is the intrinsic value in the traded quote price. So if we're converging on, full valuation, obviously the sizing of the position isn't as attractive as it once was, right? Because there's only so much room for it to grow. So, for us, it's opportunity in its life cycle of these kind of disrupted verticals. And, one of the, relatively nice things in our strategy is that, while we do kind of specifically focus on 5 verticals, everything we do is on a multi-year basis, and they're at different life cycles in their progress. And in terms of opportunity as well, we think that these disruptive events will ultimately tap on basically every component of the modern, global economy. So if the markets weren't efficient, then that wouldn't work out over an extended period of time. So a lot of it comes down to opportunity and development of the transition from one business model or one economic model to a newer economic model.
In the snapshot, we saw a certain activity in the disclosed information. Like there were only 2 positions where there was no change visible in the positions. Like what leads to this activity and what makes you, for instance, sell?
Yeah, so I think one of the things, I'll get into that in a second, but what we like to do is really, I think, philosophically let winners run. I think that what we see happen pretty often, and certainly something that Arne is really focused on is letting these companies run to ultimately, as Dan alluded to, what we view as their fair value, which can take really a period of years. And I think that there's a lot of temptation to sell. Certainly, if we see a quick pop, but we stay focused on sort of the long-term valuation. As far as when we do sell, it's a variety of metrics. Sometimes it's as simple as it could be sort of a tail risk event like March 2020 when we just want to take risk off the table. It could also be just a function of a new opportunity or an existing opportunity in the portfolio that we want to augment. So we'll transfer from one position to the next, given the opportunity set of the valuation. So that's another. And I think really it is a focus on just deploying capital effectively into these companies where we're meeting kind of where we want to be, where they can hit certain valuation frameworks, and sort of goalposts that we're tracking. And also, as we develop conviction in these positions, we want to add to them over time. So that also forces some selling from lower conviction or lower opportunity type of positions that have reached more of a fair value. But maybe Dan, I don't know if you have any thoughts there that you wanted to add on.
Yeah, nothing crazy. There was no like fundamental investment thesis change, just kind of optimization. And then, from our perspective, and really, Arne's hyper, life's work focus is to put out the best portfolio possible. So we don't use a crazy amount of leverage or anything like that. So there's some kind of tweaking around the margins that we'll do because we never want to think of ourselves as satisfied or happy with what we did in the past, because the past is gone. So all we're good for now is what we can do going forward. And so kind of little tweaks and things like that, which may not seem completely material. First we think if we can pick up any sort of returns, that's great. And then we also think it's an attractive mindset to always try to put out the best thing that you possibly can, and even if that's focusing on the third decimal point of a short or something like that. obviously without being spending too much time, but it's kind of a mindset. So yeah. But
you already mentioned.
Nothing. We didn't fire up the computer and turn one of our longs into a short or anything like that.
You already mentioned the digging you do before you invest, and that it might take years. Maybe you can explain a bit of the digging you did for your biggest position for Tesla, and can walk me through the process of falling in love with the big position in Tesla?
Yeah, sure. So I think one way Arne likes to kind of talk about just this process of digging and observation is, as Jane Goodall sort of famously, just observes the chimpanzees, right? Just sits on the hillside and just watches. And I think that's our approach to a lot of industry observation for a period of years. We don't take an opinion. We don't really try to have a strong perspective on something. We just watch as objectively as possible. I think when it comes to a big position, like Tesla or Amazon before it, which was another, which is a current position and had been a much larger position and towards the inception of the strategy. What we saw with Tesla and continue to see is a massive opportunity to completely reorganize the wealth pie across transportation and energy. And we think that, historically, the sort of analysis that we've seen on the company, you can kind of go back all the way, 2012, 13, analysts were kind of talking about the company as they are today, just fundamentally, I think, misunderstanding a lot of the key aspects of this. It's a really tricky valuation. It's a really tricky company to truly understand. And it takes years to kind of develop a thesis around it. Anyone who comes to this company overnight just looks at it is likely not going to understand it. So in terms of the actual, sort of fundamental research that we do everything possible. So Dan and I have taken, visits out to battery factories. We speak to auto dealers. We go to the industry auto shows. We go down, Dan thankfully has a good science background. We drill down into the chemistry of the actual cells and understanding how these battery packs work, what gives Tesla an advantage there. So from our perspective, the work is really never done. There is, this is like the ultimate puzzle to figure out of how the next 10 years of transportation is going to be reorganized in a new electric first, paradigm. And so from our perspective, Tesla is maybe one of the most misunderstood companies out there. That gives us definitely an opportunity to take a sizable position on a really misunderstood company. And as far as the sort of level of research that we go into the competitors, specifically to Tesla, as well as the analysis, we vacuum it up constantly. So perhaps I think what Arne would say is, like in chess or in poker, you know your hand, the pieces that you're playing with. But what's potentially even more important is to know what your opponents are thinking, and to develop a thesis based on maybe some flaws in their analysis to gain an edge or conviction there. So a lot of our time is spent really just going through the contrarian theses, understanding why people are maybe bearish on a position like that, why people may be short like it. And though we may disagree, we certainly have respect for anyone that puts up capital, to express their view. It takes years to develop a conviction in a company like Tesla, just as it did, with a company like Amazon and Netflix and some of these, in the moment, pretty contrarian type of positions.
Yeah, and we certainly didn't do it for our health. But yeah, one of the things is there are certain things that are, demonstrably facts, right? So when we look at, prismatic versus cell versus pouch, different batteries, even when we look at, who's investing down the supply chain, who's investing in battery factories, 3 or 4 years ago, what these, who's just making PowerPoints, we went to the LA Auto Show, you can do simple checks, do their big hyped EV product isn't even there and they don't know when it's coming. And from us, we look downstream. Well, you're not purchasing the necessary components to either make batteries, or get batteries. what is the effect of outsourcing your core competency, if you're a legacy OEM to, an Asian battery supplier? Are you nearly as, what's your moat that you used to have if, your traditional skill is combustion engine production, and then that's being outsourced? A lot of the mistakes that were made were saying that all of these companies could just flip, and it's still being made, could just flip a switch and then, go from one completely different way of doing business to a completely, it's very, very difficult. And if you saw the growing pains, and, even when we look at all of the different business lines that, we think respectively have tremendous opportunity for accretive value growth, the market just oversimplified it. So for us, it was really focusing on the technology, and that allowed us to then handle the deluge of information, say, well, okay, 9 times out of 10, that's not material, or that's just a great headline. And because we know the underlying business, we know the underlying technology, and we know who's actually, moving ground and who's actually just making PowerPoints. If you look at, I don't really want to denigrate like people, but it was very surface level. And so for us, that's opportunity. If a gigantic portion of the market is against you, and you see a very tremendous opportunity, and so you're able to purchase at, relatively low prices, that's, kind of all you want as an investor. Doesn't make it easy. It's extraordinarily difficult. And, you have to kind of have a compulsion to really want to generate returns. So yeah, it's slow. And, even when we look at a lot of the players in the full self-driving or autonomous space, we felt comfortable years ago that, vision and radar were going to be superior to the LiDAR and mapping paradigm. So it's a lot of things that kind of add up, and it allows you to feel, I don't know about comfortable, but confident in your decision-making process.
What else is still misunderstood in Tesla?
I think, from our perspective, what we really like to find in companies is a customer obsession. So if you just look historically at really some of the most successful businesses out there, it really starts with the customer. So we like to see, both literally and maybe metaphorically, customers lined up around the corner to get the product. And I think what perhaps is maybe most misunderstood is a little bit what Dan is getting at, which is how challenging it is to create a complex manufacturing output at scale. So this is something that we look at pretty closely right now, especially as we see a flood of new entrants into this market of prototypes. Now, prototypes are, they can look really great, especially on a slide deck, and maybe even in a presentation. You bring a prototype out on stage and you can maybe drive it around. That's great. There's a lot of enthusiasm right now for prototypes, and that is, I think, where we're going to have a lot of problems in the next few years. So what's really challenging about the auto business is complex manufacturing at scale and having enough of the supplies to actually reach those pretty lofty goals of production. Very few auto manufacturers, from our perspective, are gearing up for the crunch of supply and manufacturing capability that will enable the type of output that they are predicting. That goes all the way down into the supply chain that's required. And so, I think if you're an investor in this space, what you really need to focus on is who is best poised to succeed given their capabilities today. That's what you need to ask. And then also ask, what are they doing? If they're not prepared today, what are they actually doing to prepare for that output? And that's not just, I would say, in the hard materials or hard technology, it's the software as well. If you look at some of the competitors, and this isn't necessarily even just full self-driving or autonomous, setting that aside, if you look at the type of software platforms that are being utilized in some of the new electric powertrain platforms, I would take a real close look, because we certainly have. I've tested the the competitors and looked at their software platforms and the ability to kind of send over the air updates onto those cars. And that is going to be a really difficult transition for some of these OEMs. I think broadly speaking, the more sort of misinformation and sort of, marketing statements from the competitors, frankly, the better, because as Dan pointed out, we're comfortable with some short-term noise and misinformation as long as we're focused on the business. We're not really too focused on, what an executive would say. Arne has a sort of great idea about executives. They're gladiators in the Coliseum. They're going to say what they're going to say to make them sound tough. It's also paired with the only way to develop this conviction is to be open-minded enough to actually test out the competitors and to want to believe and to go down that path of analyzing the competitors of the business. And if a competitor to Tesla, if either a new entrant or an existing incumbent comes out with a incredible product that's winning among customers, we want to own the best businesses of these of this dynamic. And so we're open-minded to especially some of the new upstarts that are interesting to us, that are actually developing the capabilities to produce the output, that are actually having, the hard talks around, okay, we need to actually build up these manufacturing facilities. Those are more interesting to us. But it's a minefield. And I think a lot of the companies that are coming to market today with electric promises, we'll see where they are in the next 5-10 years. But it could certainly be a winner take most type of dynamic, just given the complex manufacturing and how difficult it is to scale up these businesses.
Do you want to add something?
Sure. From our perspective, one of the most important things is software, right? So, that leads to the possibility of, pretty heavy gross profit and, very successful cash flow. When we look at the competitive landscape, we're still not overly impressed. And then if we look for drivers of valuation going forward, again, the energy software component, the battery company component, auto bidder, and then the real, potentially greatest step change is the, full self-driving and what that can mean. And then, the market is still in at least in our opinion, pretty unsophisticated on the different paths that companies are going on. Eric, you'd agree on that, right? I mean, in terms of when we look at these companies with pretty heavy valuations, we think they have a chance to be at zero in, some short order. We're not looking to get in front of those trains, but it's completely different technologies. And then the difference in data accumulation it's a flywheel effect that is only going to increase. So again, there's just a ton of misunderstood. And we look at, 3 or 4 different business lines that we think can be, quite large.
Another great big position of you is Spotify. Where did you get the idea from to invest in Spotify?
If any investors are curious to sort of read a longer form piece, we have published something that if it's not available on our website, qualified investors can get in touch, which I think goes into the longer form thesis. But I think what we saw with Spotify was an early recognition that what Daniel Ek, the founder of Spotify, was building. His early insight was that just as video is a $1 trillion opportunity, there's no reason that audio can't be a $1 trillion opportunity as well. I think when we just take a step back and think about the types of businesses that we're attracted to, we like businesses that are global in scale, that are high growth, that there's opportunities for margin expansion, that are platform-based business models, and that are really sticky among their customers. So what we saw with Spotify was a company that was able to leverage their access to music, to audio more generally, to a global audience of subscribers that love the platform. And there's immense growth opportunities within there. I think I'd encourage anyone to listen to the Stream On event from a couple of months ago that the company put out that really kind of laid out and articulated the vision of true, billion user Spotify ambition, which we think is achievable. And I think that Spotify is one of those companies with a lot of optionality. So companies that we generally are attracted to are ones that maybe have multiple business lines of revenue generation. So the traditional sort of music model that Spotify has leveraged is, developing relationships with artists and then ultimately, being a music first platform. What the next sort of version of Spotify 2.0, what we view it as becoming is a platform for all audio creation. And so that's everything from podcasts to storytelling. And so it's no longer just a music platform. It's a platform for any sort of audio experience, which, as you know very well, is increasingly attractive from an investor perspective, just given, frankly, some of the dynamics that we see on these platforms, the ad rates, the retention, the consumer interest. And ultimately, I'd say, obviously, Spotify has some big competitors, Apple, Amazon, but remains to be the largest platform right now. And we think that there's immense opportunity, left over the next couple of years. They're at a bit of a pivot point for the company, but we love the optionality that they have to expand into something much larger than just music.
What, like looking out 5 or 10 years, what options could have come to real businesses at Spotify?
I think, certainly the monetization of these relationships between individual creators and their fans. We've seen business models like Patreon really explode over the last few years as a result of this sort of decentralization. So we are attracted to businesses that enable people to make money. We have a position in Shopify, which again is a platform-based business model that enables transactions between essentially, a buyer and a seller. We see this with Amazon as well. What Spotify can ultimately do is be that platform on which those transactions take place. And that will integrate both direct, likely direct relationships of monetization, but also great advertising opportunities as well down the road to really specifically target specific audiences and enable creators basically to create the content that they want to and monetize it really successfully. Certainly no other company has been able to do that with audio so far. And, frankly, Spotify is, from our perspective, the most innovative, successful disruptor in this arena. And there's immense runway for growth there.
Why do you prefer Spotify compared to the labels? Like Universal Music or other labels, Warner Music, I think it is.
I'm sorry, can you maybe reframe the question a little bit?
Why?
The music labels.
Yeah, the music labels. Like, why do you prefer Spotify compared to the labels? Hey, Tillman here. I'm sure you're curious about the answer to this question. But this answer is exclusive to the members of my community, Good Investing Plus. Good Investing Plus is a place where we help each other to get better as investors day by day. If you are an ambitious, long-term oriented investor that likes to share, please apply for Good Investing Plus. Just go to good-investing.net/plus. You can also find this link in the show notes. I'm waiting for your application. And without further ado, let's go back to the conversation. To sum our interview up, I want to ask the question, how much this self-disruption is embedded in the DNA of Warm Capital? So I think you mentioned one point that you're kind of Buffett and Munger fans, but you're always evolving and you have a certain factor of self-disruption, I think, embedded in your company, or?
It's a great question. And I think that is something that, Arne really preaches pretty religiously, is that we can't fall victim to, being disrupted ourselves. And so what that means is, being open-minded to challenge our own perspective, our own views, and frankly, just to not have opinions about any investment. Opinions are not really helpful. In fact, we pride ourselves on constantly challenging our conviction and starting each day with a fresh piece of paper. And I think that over time, this sort of highly convicted, patient approach maybe can, draw you down the path of being, kind of stuck in your ways. And we need to constantly fight that to reassess and to challenge our viewpoints, and be flexible when we need to be. So it's a great question because we do think about that quite often.
Yeah, and Arne's been at this quite a while, and from his perspective, if he's not getting a little better every year, it's not worth doing. So we just number one is try to stay humble in all of our opinions, and look to the future. And even if we have had a little bit of success, that doesn't mean anything going forward. So just try and get better, and both in our analytical work and our psychological work and all those kinds of things, and just try and keep moving forward. And because people not making mistakes, or really, really dramatic mistakes is maybe the key to success. So just try and get a little better all the time.
For the end of our interview, is there something you want to add we haven't covered that's interesting about Warm Capital?
Not too much. No, I thought maybe the only kind of thing I'd like to add is we're Arne is super competitive, right? And I think you have to be really competitive in this business to stay really focused. And so while he's not on this call, I think his message would be that he's super excited about the next 10 years, and it's just a matter of staying focused, staying truly competitive and eager to win, and wanting to attack those opportunities that we spot. So I think I would just add maybe that, well, we can end it there. We can cut that out. I don't really have anything else to say there.
Do you have something to add?
Yeah, maybe. Just that we think it's going to be a really interesting 10 years, and that there's a lot of opportunities. And then the converse to that is that we're going to see a lot of change, and positioning is super, super critical. So we appreciate the time, and thanks.
Thank you very much for coming on and answering this question so openly, and laying out your position and your approach. Thank you very much.
Thank you, Tillman. It was a pleasure.
And bye to the audience.
All right.
Bye-bye.
Bye, everyone.
As in every video, also here is the disclaimer. You can find the link to the disclaimer below in the show notes. The disclaimer says, always do your own work. What we're doing here is no recommendation and no advice. So please always do your own work. Thank you very much.